Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by foundersuite.com. Today we're trying out a new experiment. We're talking to a few venture funds and the people behind them. And our first is Vik Sasi of Dreamers.vc, coming to us from Los Angeles. How's it going?
Good. How are you?
I'm good. I'm ready for the weekend. It's Friday as we're recording this. So
Happy Valentine's Day.
Happy Valentine's Day. Yes. My wife and I are going to play Valentine's Day bingo tonight. Very exotic, exciting date night.
Riveting. Yeah. Sounds fun.
Cool. How about yourself? Any fun plans or?
Girlfriend, we're going to dinner at one of her favorite restaurants. Maybe get some flowers on the way back. Pay 3x what they normally are yesterday and tomorrow, but
right.
C'est la vie.
I was going to say, I have a sort of a moral aversion to going out to eat on Valentine's Day because of the markup, or because of the premium surcharge, right? I don't know.
Yeah.
Yeah, good. So what is Dreamers? Tell us about your fund. What's the thesis, and how long have you guys been at it?
Sure. So Dreamers is an early stage generalist fund based here in LA. The most notable aspect is that we're co-founded by Will Smith, and then a large, well-known Japanese soccer player named Keisuke Honda. He's not, he's far more well-known in Japan, just given they don't have too many athletes on the global stage. He's one of their highest scorers in the World Cup. And we launched our first fund at the end of 2018. So about October, November is when we really hit the market with our first investment. Since then, we've done about 51. So we've been incredibly active. Totally generalist. So the portfolio breakdown by sector is about 25% consumer, 25% healthcare, spanning the spectrum of life sciences, drug development, biotech, medtech. And the other 50 is kind of a random smattering of gaming, fintech, esports, edtech, all over the map. In terms of investment approach, kind of bifurcated it into two main buckets. The first is our seed or pre-product market fit, where we tend to write checks the size of $250K, flexing up to $500. And the second bucket is a first check of up to $2.5 million into a Series A or B company. I could a lot more things, but I hope I answered just the first question. I'm sure we'll.
Yeah. Well, let's talk about, I do want to get into how you operate the fund, but let's go back to the inception a little bit. So how did Will Smith and this Japanese soccer player and you all come together? How did it happen?
So each of the folks that run one of the partners who runs the entire Smith family office, and then there's a fellow named Tashi who runs Keisuke's family office. They had sort of been discussing a number of, they've known each other for a while. And so, Japan, the macro sort of trends are negative interest rates. It's hard to find yield, stagnant economy, yet still the third largest economy. And so there's trillions of dollars on balance sheets. It's a lot easier to find yield as you get out of Japan. And so, Keisuke and Tashi both have really good relationships across the corporate sector. And then Will's family office has been doing venture investing for quite some time now. And not only do they do direct investing, but they're also limited partners in the Cultural Leadership Fund of Andreessen Horowitz. So we get a lot of co-investment opportunities through usually it's the consumer deals that they end up doing that they send over. And so essentially, Dreamers was this marriage of Keisuke bringing all the Japanese corporate capital. So our LP base is actually some of the largest multinationals in the world, all Japanese based. So Nomura is our anchor. And then we have a pretty diverse composition of the rest of our capital base. Shiseido, Dentsu, Mitsubishi, ASICS, some relatively household names. And that is essentially, they're our LP base, and we're a traditional 2 and 20 venture fund. Anchored by by those two. Then I was brought on. I was previously at an insurtech fintech fund, and our venture partner, who here at Dreamers, named DA, who does a lot of our healthcare work. He and Co were friends in college. I grew up with DA in Wisconsin, and so the mix came together, and it's hopefully we're making some magic.
It's a really interesting mix. I mean, it's such a something I wouldn't have thought would be a natural fit together, right? But it's pretty interesting. Let's so I guess who's sort of spearheaded it though? Was it Keisuke or Will, or you guys all just got together over drinks one night and 10 sake bombs later this is hatched? Yeah.
I'd say it was an equal combination between Will and Keisuke. And, it really works in parallel. Our two biggest value props, Will is obviously a force. He's been in the limelight for 30 years.
Yeah.
One of the most likable, one of the most bankable people on the planet. So he serves as a honeypot for deals. I mean, we're living in this peak influencer marketing right now where there's some ridiculous statistic that 30 to 40% of venture dollars trickle down into Google and Facebook, just given how much paid media paid marketing that a lot of these startups are spending. And so when you bring along an influencer, especially someone of Will's caliber, that can bring the marginal cost of acquiring a customer to zero if they do an Instagram post or mention you in their YouTube, et cetera. So that's extremely compelling for any startup trying to build a brand, any direct-to-consumer company. And then Keisuke also just, Japan is, tends to be very forward in a couple different industries, gaming, crypto, and some other things. And then their corporations, if they had the stagnant economy, are also really looking to innovate, to bring innovation back over there. And so it's an unconventional venture fund, but we're making it work.
Yeah, interesting. And I guess picking it apart a little bit, like Japanese corporates like Nomura as anchor, had they done venture investing in the past? Have they put money into venture funds? That seems, I think of Japanese banks as being pretty conservative and risk averse. So was this new ground for them?
Yeah. I should probably say that the asset allocators in Japan have been LPs in a number of different, they've been investing in alternative assets for a while.
Okay.
The innovation side of these mega corporations haven't been exactly doing it. And so the asset allocators are looking only for returns. The innovation side is actually the best startups, and while that may be changing, are likely still in the Valley in the US. It's such a hotbed of venture activity. So how do we sort of bring that forward? And that, I think, has been a bit of a struggle over the past few decades, I would say. And so we sort of serve to bridge, our corporate capital base with the best and brightest of the Valley.
Are they looking, when I think of like corporate VC, obviously there's usually a strategic initiative attached to it. Like they're trying to, generate some innovation around their core business. But are these Japanese banks trying to do that? Or is it more just I'm trying to connect those dots, right? If you're investing in something that Will Smith is going to Instagram about, how is that getting back to the Japanese strategic charter, right?
Sure. No, so I mean, number one, like they are, completely returns focused, and equally alongside, and I can say this from a corporate, because I came from a corporate venture fund, is they do want some sort of strategic tie back. The difference is that a lot of corporates, here in America, they really, sometimes you need a business unit sign off. For them, they're mostly just want the eyes and ears of what's going on at the earliest stages. So, at a Series C or later company, capital becomes a commodity. And if they wanted to directly invest, they probably could. But going back to what you were saying about Will is, he's such a force of nature that a lot of these companies are, really want to have him on the cap table, given one, obviously the value he can bring, but secondly, it's kind of interesting to have, all these influencers. It really kind of hammers home the offering to the customers. It's like, look, we have Jay-Z, we have Will, and it also helps them to their target demographic, for customers. And so, I mean, don't get me wrong, it seemed too good to be true, when we were pitching, but honestly, we use it to bring in the best deals. And so it's not just, these corporations can afford a CB Insights membership and PitchBook and all the rest, but we're actually saying we're looking at things that they likely won't see until 2021 or 2022.
Interesting.
So that's sort of the.
That's cool. Was Fresh Prince of Bel-Air big in Japan? Did that ever translate or cross over?
I don't know, but I know the reruns are doing fairly well. But I think at the time, I mean, And it's like just stunning to think that was 30 years ago.
Yeah.
I'm not sure it was being syndicated over there at the time, but I think since it's made a little bit. But certainly his movies are extremely
Yeah, of course.
extremely popular.
That's neat. Now, maybe you can, maybe you can't disclose this, but does Will's family office also an LP in the fund, or is he more of a honeypot lure for startups, and that's his role?
Yeah, he's actually a GP. So his family office, and along with Keisuke, they are both GPs. Part of the GP commit. So yeah, it's it's very unconventional, but we also structured it that way because we wanted to sort of, as we make our pitch to founders, is that we want you to look at us as a traditional venture fund. We can follow on in our initial investments, and we also have this sort of influencer behind us that can really turbocharge our investment.
That's interesting. I do want to get back to that, but I also want to talk about actually raising the fund a bit. You mentioned you've got about 56 million in the fund. And is that fund closed, or is it still an ongoing, are you still raising for it?
So we're actually kind of at a crossroads. We're likely closed. We're actually we're going back to our LPs and kind of trying to decide, should we still try and raise and bring more money in for Fund 1, or should we go out to the market for Fund 2, just close Fund 1, and can we get an anchor for Fund 2 and just, start over? One thing that we're trying to be cognizant of is it's not, recommended to sort of start mixing deals, given that, we're going to have follow-ons. We did a breakneck investment activity pace. And so if we close Fund 1, then all we have is our reserves from Fund 1, without doing SPVs or getting to a growth fund and all these things. And so we're basically just weighing the pros and cons of that, but we're multiple discussions and already expecting we're going to go out for Fund 2 at some point. It's just, is it, in the next month, or is it in a year?
And what, for our listeners who probably aren't maybe that familiar with this, like what is actually involved in raising the fund itself? What's the sort of process like? Give us a ant's eye view, or feet on the street view of what it's like to go raise a $56 million first time fund.
Sure. And so a lot of this was done, I should add. So there are two interesting things. A lot of this was done right before I joined in October, November. The other part is that given our capital base, literally all of it was done in Japanese. So, and not just the language, which is obviously something I don't think either of us would be able to, participate in, but even just, there's a different set of culture, customs, and norms about it. And so, but that said, is that fundamentally it's the same. It's literally the exact, nearly the exact same thing as being a founder and having to go raise go raise a round. You need a lead to come in. We needed an anchor. And so we founded in Nomura, incredible capital partners. And the same thing, with this founder, it's like, okay, once you've got the anchor, then you got to go get, build the syndicate, go get everybody. And it's basically been that. And so at the time, we were only targeting corporations and, serving as sort of their eyes and ears, like an information hub. That said, I've been in some of the discussions with, once I had joined, pitching especially to insurance companies, because I did a lot of insurtech. We were in Southeast Asia at the end of last year, just talking to the GICs, Temaseks, the big sovereign wealth funds, huge asset allocators. It's a grind. And I know people always say like founders have it the hardest, which they 100% do, but even just to really empathize and, for like a hot minute, sit on their side, it really hits home how incredibly difficult and exhausting it can be.
Is it kind of in those parallels between, fundraising for a startup versus a fund? Like, how do you identify the right LPs and how do you get in with them? Is it similar to fundraising where it's all about networks and you have to get the introduction, or is Will Smith's name open up cold emails for you? You know what I'm saying?
Yeah. It's again, having him is an incredible asset to have, because everyone will take the meeting because they hope to meet him.
Does he go to the meeting, or is it more sometimes
he's like once you've committed or once it's really close, he's the last step, because he's not, he obviously has much cooler, much better things to do, I would say, than take first calls and talk about our portfolio. And the other thing is that obviously the pitch for fund 2 and 3 is different than fund 1, where it's, proof of concept and all these things. But to go back to what you were saying is, it's a similar dynamic, I would say, between like, raising as a founder versus raising as fund, is that extremely network driven. It's, warm intros only. It's a, 95% failure rate or rejection rate, whatever you call it. The things I would say that are different are that I think in startups, it's a lot more momentum driven. Like, once you have an anchor as and you're raising a fund, you still got to go out and convince a lot of people equally. Whereas in a lot of these, really competitive deals, once you have a tier 1, Sequoia's in, guess what? Everybody else who was on the fence is likely going to commit and just try and get as much of an allocation as they can.
Yeah.
And the other thing is that, rounds can be oversubscribed in venture, with startups, but they don't have too much wiggle room, because then you're kind of cramming down the lead, and, they're not meeting their minimum ownership thresholds. With funds, usually they're happy to keep on raising more. So they'll, that's a lot of times while they end up larger than their target and things like that. So there are some, differences, but
so it's less momentum driven, would you say, though? I mean, once you get a Nomura, does it all kind of shift, or is it a slower grind, would you say? Or I don't know.
It definitely shifts. I mean, the biggest part of having the anchor for us, and I think in general, is that you can just start investing. You can do a first close, and then you can be in market, because most of the time when you're pitching, you got to, like, people are sending you deals or you're trying to do diligence, but it's impossible to do both. And so once you have the first close, you can at least be in market and go back to your day job while also trying to finish out raising. Whereas if you're a startup, once you have a term sheet, the clock is ticking. Like, you've signed it, you get the wire in, you're like, we have 30 days to, raise a couple million more, take it or leave it. This is our lead. These are the terms. There's nothing negotiable. Whereas fundraising wise, people can add side letters and things like that.
Interesting. Good. How long did it take, like, roughly from end to end, just for context? How long does it take to raise a fund?
Yeah. Some people, it differs. And again, like, this is just an N of one, anecdotal or, data point of one, but I think it probably took 12 to 18 months to go from initial discussions all the way until the first close.
Yeah. Interesting. What would you say, I guess you weren't part of all of it, but what would you say were some of the key elements of the pitch, or like the unique hook or angle for you guys when you were pitching LPs, right?
Yeah, the unique. Again, going back to Will and Keisuke, having sort of this marriage of an American, global influencer like Will. The other thing that's interesting is that it's not just so the family has about a collective 150 million unique followers, but it's not just Will. It's Jada, Jaden, Willow. Jada obviously appeals to a very appealing demographic of they're. I think one of the fastest growing income segments is educated African American women, which are different to reach than something like a Goop or some some other companies that are targeting a similar demographic but not the exact same. And then you have Jaden and Willow, who are each rising icons in themselves. Jaden's on stage with Greta Thunberg. He runs his own. He's vegan, very climate focused. So there's obviously that. Again, this just hits home the influencer brand, and then also Keisuke just being sort of a force all over the globe in terms of soccer and sport. It's an interesting. I'm not saying we're the only ones doing it, but given our capital base, given what we're trying to accomplish, it certainly struck home.
That's your hook. How do you decide when you're doing a first time fund, like how big a fund to raise, and then what chunk of it do you set aside for doubling down on your winners? Is that set in stone?
Yeah. So the second, to answer for the first, the way we look at it is, and everybody who's pitching should likely have a fund model as to like what their sweet spot is. Is it seed? Is it, and then the ownership thresholds, model out what you think, 20% or, whatever it is, 40% will make it to Series A, 10% will actually get to an exit. Hopefully it's a mega exit. And then, which one's going to return your fund, likelihood, et cetera. If you have, past track record as an angel investor, that's extremely helpful. Just sort of prove that you can actually, be a professional investor. in terms of so that's just one is, I think you kind of right size, like, look, we're going to do 10 investments at this, which means we
Okay.
need much capital. But as for the follow-ons, it also kind of depends on the stage focus that you are. So if you're a seed fund, maybe you can we're going to reserve 2x more for whatever we initially invested. So that'll certainly get us our pro ratas into A's and B's. And hopefully, if we're really delivering value, we can buy up ownership. Or maybe if it's really expensive, then, that 2x will go into the next, 2 or 3 rounds or whatever. If you're a later stage fund, there's really nothing else. Maybe you'll hold on for one more. Being at, relatively multi-stage, it's incredibly difficult. And especially, we have a huge portfolio. And so now we're actually trying to, decide, do we try and just allocate a little bit, to every company, but that likely won't be the case if they come back around. It's a topic of frequent discussion. I mean, we talk about this every week. We go through our portfolio models. We follow on, all these scenarios. We try and game out, but as we all know, it's impossible to properly model these things out.
Interesting. Couple little bit of nitty gritty question, but when you're saying reserve 2x more for follow on, does that mean if you're doing a $75 million fund, you'd be having 25 million to put into a bunch of deals and then 50 million to do the double downs?
Yeah.
Okay. Interesting.
Exactly.
And how specific in your charter, maybe this is going back to what you just said, you're having this conversation constantly. If you see a deal that you love, but it's larger than your kind of what you would put forth to your investors, do you ever lose out on a deal because it doesn't fit your charter, even though you love the deal? You know what I'm saying?
So, yeah, I mean, there's, we have a vice clause. We won't do anything with cannabis, alcohol, a number of things. But as for deals, VCs love to say, we love this company, we love you guys, but the math doesn't work in that there's not enough of an allocation for them to hit their minimum ownership threshold. So on one, we don't have ownership thresholds. We're, trying to prove that, we're full-time investors. We have a good enough network so we can get into great deals. In fund 2, as we grow, we can raise a larger fund, take more meaningful stakes. But yeah, I mean, it ends up being a really, in terms of following on these, it's really hard to properly do the math as to where. So to answer your question, we have never had that position because we'd always rather be in a great company than not, and we also do look at sort of the expected value. So given our fund model, it's going to be really hard for one to properly return the fund. But if we and our hit rate necessarily needs to be a little higher than some of the other funds. But we're hoping that because we're co-investing with the best, that we will be able to accomplish that.
That makes sense. For looking ahead towards fund 2, what are the key, when you've raised a first time fund, and that's an achievement on its own, but you want to get to fund 2, what do you have to achieve? Do you have certain key metrics? I mean, do a certain number of your companies need to have had a liquidity event by that point, or just kind of marked up valuation, or sort of what, give us a flavor, what it really takes to raise a fund 2.
And so, you're absolutely right. I mean, given where we are fund 2, 18 months, 2 years after when we first started investing, there's not going to be any distributions. I mean, likely not, except for some later stage stuff. We just had our first IPO last week. But I mean, it's kind of, and you're going to have all these residual value RVPI to paid in, which is just markups. But, candidly, we look at it as just, did you do what you said you were going to do for your LPs? Because as we all know, I mean, it's kind of like with our startups, if they come back to us with a bridge round or something, and they're like, look, we hit all of our metrics, we hit all of our milestones that we told you we were going to do. Thus, you should probably, double down. And it's that's true. We believe in your vision. We still do. And so, so we kind of look at it as the same as.
Did you do what you said you'd do?
Yeah.
Yeah. Is there when you're going out fund 2 though, do you take around your sort of implied valuation based on additional rounds that I'm probably missing some keywords here, phrases, but our investment in this hasn't, generated liquidity yet, but it's marked up 3x because they did another round. Are you taking sort of your implied valuation of that first batch of companies? out?
Yes. We'd be remiss to not be talking about our markups, and one thing is, like, with Fund 3, you should actually have, depending on the time between funds, of like real distributions or real sort of like proper exits, to see sort of where you were in your model and how you're performing. But so to answer your question, yes, absolutely, we're using RVPI, but it's not a terribly good indicator because we're 2 years into what's 5 to 7 years, if not 10 years, for some of these companies.
I just think it's an interesting topic for anyone like curious about what it's like raising funds. Like, what does it take to raise that first fund? And then, of course, hopefully that's not just the end of it. What does it take to raise that second fund, which, just like startups, it's a higher set of kind of criteria. Interesting. When you've got Will Smith, which is so cool as a hook into the whole value proposition of Dreamers, is it explicit? Like, if you find a hot startup, is it ever explicit? Like, Will, I mean, I'm being very like granular here, but will tweet out once a quarter about your product. I mean, do you ever get down to that level of like specificity as for the startups,
Yeah, we try and keep it we don't get into that level of granularity. And, one of the things that we want to do ultimately is, as Dreamers, we want to basically put you, so, Will is an extremely, down the hall, extremely active, Instagram, social media, and content unit. And so what we aim to do is put the founders of our portfolio companies in the same room as the creatives and let them come up with something that matches the vibe of what they're going for. Obviously, the last thing we want to do is dilute the brand of either our portfolio company, but especially Will, or member of his family, or whoever. But to answer your question, no, we try and really not make specific, guarantees or contracts. And the other thing I'll say is that, oftentimes we get asked, can he do this or that? And then it's like, some of these things actually are borderline very commercial. And so it's like, look, that's like, that's something that he could be paid like a pretty significant, endorsement sum for, or something. So that's, sometimes like that should maybe go to the business manager. Like, this is like a serious in-kind contribution. We haven't, crossed that bridge yet, but it's top of our minds, of course.
I think it's, and maybe, taking a step back from just what will do, almost like you're seeing this whole trend of these celebrity-led venture funds, right? I mean, Serena Williams and Ashton Kutcher might have been one of the first guys to, it's interesting, right? There's a whole trend in some of these, I think Andre Iguodala has one, right?
Right.
So it's always, it's more of a question of like, all right, so if you're going to partner up as a startup with a celebrity-led venture fund, what's the realistic outcome you're going to get from that, right? I think that's maybe, I don't know.
Yeah. No, I mean, well, one thing that I will say is that, and this is one of our portfolio companies named Step, which does sort of banking for teens, and an overlooked segment up until now. Simply mentioning Will's name in their press release got them about, 250,000 to 300,000 likes and shares on LinkedIn across all these things. And then because of that, it was like hit this flywheel where Variety, Essence, and a lot of other like traditional publications and magazines picked it up and started doing articles. And so that's one of the things that we sort of turbocharge, that in terms of value we can provide. And the other thing I'll say is that, we're not leading deals. We're taking, sort of smaller bites at the apple. And so like, we're never going to breathe down the CEO's back, or like, if your VP of engineering, quits at 2 a.m., like, we've never said we should be your first call. We'll take it. But, we offer two things. We offer the influence part with the Smith family, connections to Japan, both in market entry or a commercial or operational deal. But we're not going to take 20% of your company. We're going to take, basis points or a lot less. And then hopefully punch above our weight when we bring those other two value props.
That's interesting. Let me ask about that for a sec. So was that a specific strategic decision to not lead deals? And if so, like, why?
Yeah. So one, it was 100% a strategic decision. The first is because, we're to look at this as kind of a proof of concept. It's fund one, like venture, startups, it's a marathon, it's not a sprint. One, when you're leading, obviously it means you're going to have a lot more conviction. You're going to have to, sit on the board, make a lot less investments in the 51 we have. But two is that we want to be a good, and everybody, talks about being a good player in the ecosystem. But, when you lead deals, other funds, especially the great ones, are going to look at you as competitive. And so they're not going to send you as many things to work on or syndicate. And so right now we're friends with everybody, and we want to be, in perpetuity, essentially. And so the only way to do that is to not look, competitive at all. And so, yeah, that's essentially where we are. And we'll likely stay that way. I mean, we have thought about leading maybe pre-seed deals, going forward, and then we can send them to our, all the Sandhill funds for their seed or Series A. But for now, we're friends with everybody.
That's interesting. So does that change your deal flow kind of pipeline? Is if you're not leading, do you get, how do I ask this question, a lot more just, from lead investors versus maybe directly from startups or connections through, startups to you? Does that make sense at all?
Yeah. No, it certainly does increase our inbound from our co-investors, especially the ones that we really like to work with. And so that's where our filter, we're like, can we take on, does it make sense for us to do this? But it's a great problem to have. I came from my previous fund where I would have to, pound the pavement, get in front of these founders, make a case for, just sell our money. And when I moved to Dreamers, everything's 100% inbound. Obviously, I didn't have someone of Will Smith's caliber at my old fund. But here it's largely about network development, making sure we're staying on top of mind with our favorite syndicates, and taking it from there.
Cool. All right. Maybe one or two more questions. I'll let you get back to it. But what's just big picture? What's the hardest part of running a first-time fund? Very open-ended question.
The hardest part is maybe not being able to have a second or third fund. I think we're all aware of this explosion, this influx of capital, both in terms of the amount of capital that's coming into the venture startup ecosystem, the number of new funds that are out there. Everyone, has a core differentiator. So for us, it's really proving our model that we can do this, that this makes sense. I don't just mean in terms of there's a recession, but like, it's really hard. Venture, as I understand it and have studied it, does not scale as an asset class compared to a lot of other asset classes. And so, it's the riskiest for a reason. So to us, that's like, were I to say that I have anything that keeps me up at night, it's making sure that, sort of our approach in terms of like portfolio modeling, portfolio management, following on and all these things, that it holds true. Especially because the feedback loops in venture are years long, like a hedge fund where, you get your bonus not quarterly, but, annually essentially. And so for us, it's like, we're all in this for the carry and for, doing right by our founders. And so that's probably the hardest part. And again, I just want to make absolutely clear, I am in no way, shape, or form comparing this to the slog and the grind of of founders, in the C-suite and CEOs and everything. That is orders of magnitude more challenging and exhausting than what we on the other side of the table are going through.
Yeah. That's interesting. So that's a good answer. Again, and to achieve that, to make sure you can raise a second fund, do you think, if I force you to pick like one lever to focus on, whether it's asset allocation, picking the right startups, or adding value to your portfolio, or, like, what do you focus on as like your primary kind of lever? Is that a fair question?
Probably. Yeah, it is a fair question. Candidly, you've already had, I'm sure, lots of, and will have lots of folks that are, like 3 jobs of sourcing, selecting, then managing. Probably picking is, it's really hard to actually place, where do we spend like the most of our time? Personally, it's probably now portfolio management, given that we have 51, children, 51 babies in our family. That, is an immense amount of, just time management, that I need to do. But I think, honestly, it's, and just going back to the earlier question is, look at something like WeWork and just the Vision Fund. 2 years ago, if you had a portfolio company that, obviously got to the scale that WeWork did, or had Vision Fund come in, you're basically like, wow, like this is amazing, because they're in, we're good. And it's like, oh wait, like things can happen 5 years down the line that all of a sudden that price per share takes an 80% haircut. And so that's the kind of stuff where, and no one can predict this, no one can model that out, but that's essentially the stuff where it's like, things can be looking really, really good in venture until they don't. And we've had a couple notable shutdown brand lists, a vision fund company. I mean, they're all laying off, focus on profitability, all the rest. And so to us, it's just focus on the fundamentals, capital efficiency, keeping CAC low, or the CAC LTV ratios, et cetera. So, to us, it's this back to basics. We fundamentally believe in mean reversion, just here and in a lot of things. And so we're still in, I guess we're still in this bull run that may continue. Who knows what's going to happen? But I mean, we just take it one day at a time. But that's where kind of like picking comes in is, we try and think, yes, this is a macro trend. Everyone's really climate focused now, but what could happen after the election? And, if it could go so radically different that maybe we'll rejoin the Paris Accord in 8 months or something. And then, Bernie's going to do all these executive orders or whoever,
right.
Or it's going to be 4 more years of our current. And then it's like, actually, maybe there won't be as much movement in this space. We're not taking, a side, whichever way it goes, but it's just impossible to kind of, see where this goes.
Sure. Yeah. All right. Last question. If any startups are interested in reaching with you guys, or maybe let me put it this way, what are you looking for? It sounds like you've done a lot of these deals, so maybe you've stopped investing in new deals. Is that accurate? Because you've kind of funded 51 deals already, or not? What are you looking for? And if so, tips for getting a hold of you guys, or
Yeah. So so number one, or I'll start with, we are still in market. We are still actively investing. We still have a couple million of dry powder left from first fund for first checks. Everything else we're reserving. And then in terms of things that we're looking for, we're generalist. We really like to co-invest with top tier funds. That kind of goes without saying, and it certainly is leaves us prey to to sort of like falling like the Theranos problem of everybody. It's everybody's following each other, and then it was like, oh wait, there's nothing under the sort of under the covers. But this is why we do our own diligence. But in terms of things we're looking for is fundamentally, especially at the early stage, it's a founding team that we believe in. It's up and to the right user growth or engagement, preferably organic. Kind of potential for uncapped upside, which basically means like, are they creating a new market? Something that we've never thought of before, like sort of blue sky potential, just no ceiling to that. If they figured out the business model, or if it's pre-revenue, because we look at things really early, but has, sort of compelling monetization opportunities. We think those are really interesting. Obviously at the early stage, there's no way to really have a moat, but if you have a compelling theory on like a long-term source of defensibility, we really appreciate that. And that usually comes from folks that are, really industry specific, have spent, considerable amount of time in one vertical and are, coming out and they're like, I really see this problem. I know this can last. And then ideally, and, this is going to be echoed by every venture investor, is capital light. So, this is why software over hardware has always been favored, but, we've looked at both. We've done all sorts of, we've done some B2B SaaS. We've done the, Elon's, the Boring Company. Did
you really?
Funnels. Yeah. So, we'll look at anything and it's, and then the last thing is, my email is Vik, Vik at Dreamers.vc. I respond, or somebody from our team, responds to literally every email. And so, yeah, we certainly don't invest in everything that we get inbound. But look,
but I'm gonna press you on that. Have you ever done a deal that came through like a cold email?
We haven't, but we've come close.
Yeah.
And don't get me wrong, the hit rate is extremely low, and there's already sort of like this adverse selection, like if you can't find a warm intro and all the rest. But at the end of the day, we very much, we all have this theory like about disrupting the warm intro is. It just means it's vetted and validated by somebody who you trust. It shouldn't preclude you for doing something that, that isn't. Yeah. So we haven't yet, but I suspect that'll change down the line. And again, we fundamentally believe, and we follow Ben Horowitz's rule with this, where he, he basically, obviously, Andreessen sends like a survey to all of their after they do a first call to all of the entrepreneurs of saying like, you know, how do we do and all these things. And the other thing is that, you know, their internal culture is if you ever criticize a founder, an entrepreneur, their idea, their whatever, you know, in sort of an excessively joking or pejorative manner, I mean, that is grounds for, I mean, you leaving the fund. And so we follow a very similar role. I mean, again, obviously there are lots of startups out there. They're sacrificing a ton, and the least we can do is just have nothing but respect for what they're trying to build. And at the end of the day, the most successful founders all came off totally crazy in the beginning. So the least we can do is just assume that this could be one of them too.
Right. Good. Awesome. Okay. Well, Vik, this is cool. If people want to learn more, it's Dreamers.vc, right?
Yeah.
And you've given your email, which is super nice and thoughtful. Obviously, anyone listening, go check out the portfolio. Make sure this is actually a good fit before cold emailing Vik. But good stuff. All right. Well, happy Valentine's Day. Thank you for your time, and good luck with the portfolio. It sounds like a pretty fun gig you've got there. So
yeah, thanks. Yeah, look forward to it. Thank you for the opportunity. See ya.